All right, let's get right into it. Today we're talking about the fastest ways you can actually start living off dividend income. We're going to skip the fluff and jump straight into the practical strategies for making financial freedom your reality.
Just think about that for a second. A world where your money is out there, working hard for you, generating cash that flows into your account month after month. It's not some far-off fantasy. It's a real achievable goal, and dividend investing is one of the absolute best ways to make it happen.
So, to make this real, not just some abstract idea, we're going to focus on a very specific number: earning $2,900 a month in passive income. For a lot of us, that's a truly life-changing amount of money.
So let's use an example. Meet John. His big goal is to pull in $35,000 a year in passive income, which, breaks down to that $2,900 a month. We're going to follow his journey to see exactly what it takes.
So the big question is, how in the world does he do it? And more importantly, how does he do it fast? Well, we're about to break down 3 totally different, fast-track strategies he can use to make this dream a reality.
But first, before we jump into the strategies, we've got to make sure we're all on the same page. You can't build a house without knowing what bricks are made of, right? So, what exactly are dividends? Think of it this way. When you own a stock, you're literally a part owner of that company. And when that company turns a profit, it might decide to share a piece of that pie with its owners. That's you. That payment, that's a dividend. It's your reward for being an investor.
Okay, so how do you know if you're getting a good deal? That's where dividend yield comes in. This is like the most important number you need to know. It tells you exactly how much cash you're getting back for every single dollar you put in. The higher the yield, the more income you're getting for your buck.
And don't worry, the math here is super easy. Just like you see on screen, all you do is find out what the company pays in dividends for the whole year, and then you divide that by the stock's current price. So if a stock costs $100 and pays out $10 in dividends, bam, you've got a 10% yield. It's the key to comparing different investments.
And here's the real magic of it all. The goal is to build up a portfolio that just keeps paying you, generating this steady stream of income so you can live off the payments without ever having to sell the original investment. It's like owning a money tree that just keeps dropping fruit.
Okay, basics are covered. Now for the good stuff. Let's look at the 3 specific fast-track strategies John can use to hit that target of $2,900 a month.
All right, strategy number 1. Covered call ETFs. Now, these are really interesting. These funds don't just hold stocks. They also generate extra income by selling what are called call options. Basically, they're selling the right for someone else to buy their stocks later at a set price. It's a way to squeeze extra cash out of the portfolio on top of the dividends.
A few of the big players in this space are funds like XYLD, OILDK, and EWZ. These are the kinds of ETFs that are built from the ground up specifically for high monthly income.
And this is why we're talking about them. Just look at these yields. We're not talking 2 or 3% here. We are deep in the double digits. This is what makes them a legitimate fast-track option.
So what does that mean for our guy, John? Well, to hit his $35,000 a year goal with these kinds of returns, he'd need somewhere in the ballpark of $280,000 to $310,000. That's a whole lot less money than more traditional dividend routes would demand.
Okay, moving on to our second fast-track option, high-yield REITs. A REIT is a real estate investment trust. These are companies that own and run properties that make money. Think apartment complexes, shopping centers, office buildings. And by law, they have to pass on most of that rental income to investors like us.
And some examples you might see out there in this category are REITs like Two Harbors, Brandywine Realty, and Orchid Island Capital.
And wow, just look at the potential here. The yields can be absolutely massive, sometimes even pushing 20%. Plus, a huge bonus with a lot of REITs is that they pay out their dividends every single month, which is perfect if you're looking for that regular, predictable income.
If you look at the historical average, which is about 10.8%, John would need to invest around $320,000 to reach his goal. It's a fantastic option for sure, but you do have to be aware that these can get hit pretty hard if the economy takes a downturn.
All right, for our third and final strategy, we're shifting gears a bit. We're talking about the dividend aristocrats. This isn't about the highest yield. This is about rock-solid stability and reliability. These are special S&P 500 companies that have increased their dividend
every single year for at least 25 years in a row.
Yeah, you've definitely heard of these guys. We're talking about household names, blue-chip companies like 3M, Leggett & Platt, and Walgreens. These are the titans, the ones known for their incredible consistency.
So what's the catch? Well, there's always a trade-off, right? For all that incredible stability, you're looking at a lower yield, usually around 7%. Because of that, John's going to need more cash up front to hit his goal, around $500,000. It's a bigger number, but it comes with the peace of mind that you're investing in companies with an amazing track record.
All right, so there you have it. 3 totally different ways to get to the same goal: high-octane ETFs, high-yield REITs, and the super stable dividend aristocrats. So how do they really compare? And which one should John pick?
This table really puts it all into perspective, doesn't it? On one end, you've got the covered call ETFs. They need the least amount of money to get started because those yields are so high, but you're taking on a bit more market risk. The high-yield REITs are kind of that middle ground. You get monthly payouts, but they're sensitive to the economy. And then you have the dividend aristocrats. They need the most money, but man, they are rock solid. So the fastest path really depends on how much you're starting with and how much risk you're comfortable with.
So at the end of the day, there's no single right answer. It all comes down to what John and you are really looking for. Are you trying to get the highest income possible, right now, whatever it takes, or is long-term, slow and steady growth more your style? Figuring that out is the real first step on your own path to financial freedom.